Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Sharif Abdu. Today, we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data information and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The nation added an estimated 223,000 jobs during the final month of 2022. That figure was down from the previous month's revised tally of 256,000, but above the consensus forecast, and yet another sign that labor market conditions remain tight. The December gains pushed the 2022 estimated 12-month jobs creation figure above the 4.5 million mark. On the other hand, inflation is beginning to respond to the efforts of the Federal Reserve. The Labor Department reported that the CPI fell 0.1% in December. The core consumer price index, which includes the more volatile food and energy components, was up 0.3% last month. On a 12-month basis, the CPI and the core CPI were up 6.5% and 5.7% respectively. All the readings were indications that the Fed's goal to slow demand to better match supply and ultimately put downward pressure on prices is beginning to be realized. There were parts of the Labor Department report that had to please the Federal Reserve. Specifically, the average hourly wage climbed just 0.3% last month and was up 4.6% over the last 12 months. The latter figure was down from the 5.0% increase recorded in November and suggests that the Fed's goal to slow wage growth in an effort to fight inflation is starting to materialize. It also is worth noting that the labor force participation rate rose to 62.3%, which means more people are looking for work, and the expanded pool of job searchers may put further downward pressure on wages. Nevertheless, Federal Reserve officials have continued to say that more work needs to be done on the inflation front. This would include pushing the federal funds rate above the 5% mark and keeping it there for an extended period to effectively fight inflation. Wall Street may not be in lockstep in such thinking and believes that inflation is moderating and more benign future pricing data will cause the central bank to pause on the rate hike front later this year. Hence the drop in Treasury market yields and notable equity market rally in the session following the December labor report. Meantime, the U.S. economy is showing signs of weakening despite the still solid job creation. According to the Institute for Supply Management, a trade group, manufacturing activity contracted for the second straight month in December. Likewise, non-manufacturing services activity declined to 49.6 last month, well below the market forecast of 55, and the first contraction in the services sector since May of 2020. The inflation situation appears to be improving, but for the Fed to see its job of stabilizing prices is done, tight money may continue long enough to potentially come at the near-term expense of the economy and corporate earnings. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located here. This is the main landing page for subscribers. Under the quick links, click on supplementary reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now we're going to go to the screener. Let's move on to one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Okay, let's go to the screening criteria. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and the possibility of a recession. So today, we want to emphasize a good balance between financial stability and upside potential in the intermediate term. So we'll start the screening process by looking at safety and financial strength ranks in the ratings and ranks section. Okay, for the first filter, a safety rank of 3 or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with safety rank of 3 or better. And by applying that first criteria, we've trimmed our potential candidates down from 5,700 to 2,073 candidates. Now let's go with an additional level of security by applying financial strength ratings. Financial strength of a B+ or better is the next screen. Now, although it is already a factor in the calculation for safety, I'm going to also include the financial strength. These grades range from C to A++ in 9 increments. We are going with companies that garner a financial strength score of B+ or better. Similar to the safety ranks we just used, we want a balance of a decent balance sheet and financial stability and upside potential. And by applying this criteria, we've cut the list of candidates down to 1,635. We've looked at risk measures. Let's now apply some performance metrics. We'll start in the ratings and ranks section and look at the timeliness ranks for industries. And the third screen we're going to apply is the timeliness stocks rank of 2 or better. Timeliness is a proprietary value line measure that evaluates a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want to focus on stocks that will, at a minimum, move in tandem with the overall market, but still give us upside beyond that. And by applying that screen, we've trimmed the list to 304. The fourth filter is the technical rank of 2 or better. This next criteria is also in the ranks and ratings section. And whereas timeliness attempts to quantify the outlook for the equity, our technical score is more focused on stock performance based on historical price data. We're looking at companies with a technical score, again, of 2 or better, and now we've got the list of candidates down to 136. Finally, we're going to apply one more performance criteria by looking at the 18-month TPR midpoint, the 18-month target price range midpoint of 45% or better. Now we want to expand our time frame from the short term, that is 6 to 12 months, and actually fewer than that, to the intermediate term, that is the 18-month investment horizon. Scrolling up to the company data section, we're focusing on stocks with 18-month appreciation potential of 45% or better to the midpoint of our 18-month TPR. And by applying this screen, we've chipped away at the list of prospects from 136 down to 8, I believe. And those are our final 8 candidates. You can make strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Mosaic. The ticker symbol is MOS. Before I click on Mosaic, please note that screens can be saved and revisited by utilizing the created Save Screen button at the top, as you can see there. Thank you, with the screen name. I guess we'll use web. Thank you, 1/2023. As for Mosaic, let's take a look at our last full-page report, which was published in December. Do that by clicking on there. As you can see in the statistical array, or the center of the report that includes the financial data, there we go. If you could make that bigger, that might be helpful. Again, as you can see in the statistical array, or the center of the report that includes the financial data, Mosaic's earnings likely more than doubled in 2022, reaching all-time highs. Revenues and earnings per share are set to decline in 2023, granted, as margins and revenues come down from record peaks. Still, the investment thesis highly depends on the stock's depressed valuation. Obviously, one must be careful with cyclical companies, but we feel that the current PE multiple overly discounts price declines in the potash market. Commodity markets are still relatively tight on a historical basis, boosting demand for their products. The target price range is 50%, or now it's 50%, but if you want to take a look at the commodity markets, they're still relatively tight on a historical basis, boosting demand for Mosaic's offerings. More importantly, we think the stock market participants will have greater appreciation for Mosaic's relatively large cash flows as corporate America's earnings growth becomes more in question as the year progresses. The company is set to delever its balance sheet and also buy back even more stock in 2023. If you take a look at some of the quantitative metrics, the stock has solid marks across the board, including a safety rating of 3, financial strength score of B+, and a beta of 1.20. The issue is ranked above average for year-ahead performance, ranked 2, and the upside median price for the 18-month target price range is 50%. The 3 to 5 year, more than 100%. That 3 to 5 year interval is well above average, as is the 18-month. It should be noted, I believe the median for value line right now stands at 22 or 23%. All told, we think that Mosaic is poised for strong results in 2023 and beyond, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation. And now I'll hand it off to Alan and Sharif. Thank you.
How you doing? This is Alan. Charlie, thank you so much for a great presentation. We had a few questions prior to the presentation that I wanted to address. One is from Ned. He said, why are there so many less stock splits than maybe 15 to 20 years ago? For newer investors, it seems to me that lower stock prices would attract the younger/newer investors. And Ned, that's a great question. The investment world has, changed over the last 15, 20 years, like every other industry has changed. There's a lot more institutional trading, and a lot more people are investing in funds and things like that. And also there's a way to invest now in fractional shares. So, in the old days, like if IBM or, one of the other stocks, the bigger stocks got up to too big of a price point, they would do a stock split and, to make it quote unquote more affordable. But now with the advent of fractional shares, that kind of made stock splits much less prevalent, especially with the cost involved and everything that's involved with, kind of like, the headache of splitting each share and et cetera. So that's the main reason from our viewpoint why there's not as many stock splits nowadays. There was also a question, what do we mean by capital in PDF reports? If Sharif could just go down to the capital structure, please, on Mosaic. When we talk about capital, we're talking about the company's access to capital markets, and that's through debt, equity, or some kind of hybrid, maybe preferred issuance or something of that nature. So we're talking about any access they have to the capital market. So capital basically means debt, equity, preferred stock, or what have you. And as you can see with Mosaic, right now its debt to total capital is 22%, which is pretty low. It's on the lower side, and then also Charlie talked about, the deleveraging of the balance sheet. So, we look for that, that's exactly what the company's been doing, or we, intend to do in the short term is to continue to delever the balance sheet, over the next year or so. And, and like I said, I would say the standard industrial company has a debt to equity ratio of somewhere around 30-35%. So it's still pretty low as far as that goes. Also, I want to talk a little bit about the different, the timeliness rank versus like the 18-month appreciation versus 3 to 5 year total return. And, Value Line for many, many years had, the timeless ranking system in the 3 to 5 year total returns, target price range. And I think probably about 5 or 6 years ago, we introduced the 18-month target price range. And that's because, there's some people that are looking for the short term. They have, $10,000 to invest the next year. What's a good stock to invest in the next year? They look at the timeliness ranking system. Okay, it has a 1, let me, put some or all of that in that stock. Other people might be like, well, listen, I have like a 3 to 5 year window or perhaps more, what stock's a good, choice for that. And there's also, investors with more of an intermediate term, time horizon. So that's why we instituted the 18-month target price range. And as you can see, Mosaic's target price range is very good for that. It's well above the midpoint, and that's a metric that we definitely focus on, especially in this environment with all the uncertainty and everything. And I think it's good to incorporate that, with the other rankings that we do. There was also talk about, the safety rank and, Mosaic's safety rank is a 3, which is pretty much middle of the road. There's other variables we look at, like the beta, which, as you can see right underneath it, is 1.2, which is just a little bit above the broader market, but really nothing. It's pretty much in that range, right around the broader market. So, when you incorporate all that together, Mosaic's pretty much a middle of the road, investment. Factors are pretty much middle of the road. So, and also someone had a question about the the PE multiple, and if you look at the historicals for Mosaic on the array, it used to trade at a much higher PE multiple, and now it's trading, at just over 4 times, which is about a quarter of the overall market. And, so that's one of the reasons, as Charlie brought up, that we do like this stock. We think it's a quality company, but we also think it's a good value where it's trading. And it's also trading, if you look at the 52-week, trading band for last year, 2022, it's right underneath the dividend yield up there at the top. It traded in a band of $37 and change to $79.30. So it's when this report was written, it was still towards the lower end of that band. So that's something to also keep in mind. There's other good questions here about the holding period. Someone asked about the timeless rank being a 2. What's the holding period? We don't necessarily tell people when to, sell, but we like to look at everything in a in kind of like a vacuum. Like the timeliness rank, if it's a 2, yes, it is likely, based on our system to outperform the year ahead. But like you said, you have to incorporate the 18 months, you have to incorporate the 3 to 5 year, you have to put the safety metrics in, all that good stuff. So it's not, we don't look at everything. We try to get a perspective for different types of investors because, like, as I said earlier, there are investors with shorter term horizon and some with a longer term horizon. Sharif, did you see any questions that caught your eye? Oh, and somebody also, I'm sorry, that I don't think we touched upon too much, but the stock also does pay a dividend. It's a little bit below the value line median. It's about, at the time of this writing, it was about 1.8%. So that's slightly above the value line median, but when you bake that into everything else, when you account for that, that's just another sweetener, so to speak, for the stock. That it does have an income component. I mean, if you're an income investor and looking, purely for income, this probably isn't a stock for you. But if you see that it's got fairly good, not fairly good, very good, capital gains potential for 3 to 5 years, and it has a dividend, that could be like a little sweetener for that. So that's another thing to keep in mind. Someone also said if you join the webcast late, this will be available on our YouTube channel, on the Value Line YouTube channel, so you can look for that in case you miss anything or you want to hear it again. By all means. And someone also asked, what's the difference between the financial strength and the safety indicator? And the financial strength, by and large, is for the company's metrics. We look at the capital structure, we look at the current position, we look at, the earnings, the future earnings. We kind of like tie everything together to get the company's financial strength, whereas the safety rank is more about the stock. I mean, they usually go fairly hand in hand. I mean, most companies with like an A++ financial strength rating are probably going to have a pretty good safety rating, and vice versa. So, but that's also something to keep in mind, that safety is more about the stock, financial strength is more about the company. And I believe that's all the questions that I have. I'd like to thank you all for joining us today.